Hello and welcome to the Property News Show, where every week we bring you news as it affects landlords and investors in the UK. As always, I'm joined by Mark Homer, the founder of Progressive Group and a professional property investor. Got a very special episode for you this week. Mark is going to be talking about everything he's going to be doing in 2020 and giving some very special tips and predictions on what he thinks is going to happen, and importantly, what you shouldn't be doing this year. Hello and welcome to the Property News Show. We've got special episodes for you this week where Mark is going to talk about what he's got planned for 2020. So we've had some huge things happen at the very end of this year. The biggest one for us in the UK is the election and the surprise landslide majority for the Tories. And then of course we've got Brexit still looming over the whole of the economic landscape. So got a few questions for you, Mark, but before we get started, can you just tell us where people can find and follow you online?
Yeah, progressiveproperty.co.uk, Instagram, Twitter. My podcast is Mark My Words, and I'm on Facebook as well.
Okay, great. So we've got a few questions to go through. Just want to give everyone at home an idea for what you're doing next year with property, so they can see, someone of your experience and caliber, what you're going to be spending 2020 doing and how that affects things. So first of all, what are the top three things you are going to do in 2020 and the things you're going to be looking out for?
Well, my response has moved significantly since the 12th of December. Clearly, the election for me has changed everything. It has brought certainty back. One of the biggest things for what I do on a daily basis is, the fact that Corbyn is as far away from the levers as possible. It seems very likely that he's gone now, which is going to be great. Obviously, he's going to continue to be the leader of the Labour Party, which is like the Christmas gift that keeps on giving right into the new year for me, anyway. So for me, that brings certainty. This whole notion of rent control seems to have gone away.
Yep.
Right to buy on residential properties seems to have gone away. Yes, they're going to repeal the Section 21, but they say they're going to increase protections for landlords in terms of the ability to evict tenants when they are non-paying or breaching the tenancy agreement in other ways. So, for me, this is positive, and it's very positive for the residential property investment market. I was sort of at the stage where I was at a crossroads. I was going to develop out what we'd got, and then make a consideration as to what sort of developments I was going to do and whether they would be wholly commercial from 2020 onwards, because of the acrid direction of policy, mainly brought on by John McDonnell. And
that would be a complete change for you as an investor and a developer.
It would. I mean, the Conservatives wouldn't necessarily have implemented this stuff, but of course, the fact that you'd got the Labour Party just waiting in the wings, and at any moment it appeared that they could grasp power. For me, I just couldn't invest in areas that I thought were going to get hit harder. So a lot of that fog and mist has lifted, and for me, I'm feeling really positive. So I think there's going to be more legislation which will clip the wings of landlords and maybe not, we're not going back to Margaret Thatcher, but I think there's stability and a clear direction. So I'm going to continue to buy buildings, convert them. Yes, there'll be commercial there, but I'm going to continue to do my residential stuff. So that might be into apartments, into cluster flats, into sort of residential stock. I'm feeling really good about that.
Do you think, obviously, we've had, such a long period of uncertainty, and it's brought the market to, almost a standstill.
Yeah.
That's likely to pick up as we get increased certainty.
Yeah.
Do you think there's a window now before that starts to have the upswing, where, savvy investors can get in and get some stuff which almost is going to be guaranteed to go up in value? Yeah,
I'm tipping central London. I think that those, the real primary areas have suffered 20-25% falls. I think they probably reached the bottom in the this final quarter in 2019. They've probably already come back a little bit, although that might not be reflected in the data. I think at the coalface maybe things have strengthened a little bit. But yeah, I think that those areas are they're going to probably do. They could do the best over the next few years because they're coming off a much lower base, and B, they were the reasons they fell and the reason they were affected so much was primarily this Brexit story, uncertainty, Corbyn, stamp duty, and 3 out of the 4 of those things look like they've gone away. But it does take a little bit of time for the confidence to come back. And there's all these. A lot of that is foreigners sitting on the outside. They don't. Yeah, they can see there's been an election. They don't necessarily. Got to wait for someone else to go first. Exactly. Someone else goes first, but you can just see the direction of travel, and I'm feeling a lot more confident about that sort of stuff. I won't be buying that because it's low yielding. Yeah. But I think you could invest in a lot of worse places than London from here on out.
And do you think that any of the pledges to increase the economy of the north and invest more in the north, is that going to have any short-term impact, or do you think that's a long-term project that we might not see anything from the next few years?
I think it's really long-term. We're talking here about Boris repaying the electorate in the north who have sort of lent him their Labour vote,
brought down the red wall,
and brought down that red wall, which spans the north of England. In this Parliament, which is the next 5 years, it just doesn't. The north is not a small place. The amount of the infrastructure in the north of England has not been conceived, sort of developed and built in the last 5, 10, or even 100 years. It's old, and there's a hell of a lot of it, and we don't have unlimited resources or funds. And 5 years is not very long. So clearly he's going to have to target certain areas.
Probably make some showcase promises.
Yeah, and there'll have to be pledges because I don't know what you can deliver in 5 years, even if they get going now. And remember, they're dealing with Brexit first. So, hopefully you can keep lots of those sort of northern voters on board.
But you wouldn't be saying to people, buy some cheap property in the north now.
Well, I not because of what Boris is apparently going to do. Would I go and buy rental property in the north of England in good areas that yield well with good tenant demand? Absolutely, I think it's a great idea. But I'd be saying that anyway. This whole notion of hotspots anyway is misconceived. I think to try and predict where this money is going to go and the effect it's going to have in the time frame that you're expecting is naive. I see people do it a lot, and it doesn't really work. So invest in the areas you were going to invest in anyway. Yes, it's going to be fun. Yes, I'm sure they will spend some more money up there, but as to the effect of it and where it's going to happen, and I think that's in the lap of the gods.
Okay. And what things won't you be doing in 2020? What would you say to people to avoid doing next year that might be something they think is going to be a good idea or they were going to do? Has anything changed that makes you avoid certain things?
Well, I suppose I wouldn't be buying retail for just pure investment if you're not going to then add value. I love buying retail because it's cheap and then converting it into other uses, and then maybe keeping it a bit of retail on the ground floor, that sort of thing. But that retail sort of car crash, lowering rents, Amazon chipping away, and things going online. That's a slow motion car crash. That's going to continue. But conversely, the new retail, which is warehousing and distribution, because a lot of these online retailers are based in those kind of units, I wouldn't necessarily be rushing into those because, the perception is that that's the right place to invest, and therefore the yields are very low in those areas because the capital values have risen so much. So I think you still need to be opportunistic, trading based on the opportunity, buying things that are the right value that you can add the most value to, and as ever. That doesn't really change.
Do you think you would have anything to say about serviced accommodation? We've seen some changes and lots of talk of changing, and tightening up the regulation around there. Do you think that's something where you'd say to people, be careful if they're thinking about going all in? Because obviously people talk about, the great yields you can get from the serviced accommodation, or do you think people should just carry on as normal because that's going to take a long time before we see any real regulation change there?
Regulation change in furnished holiday lettings is guaranteed. There's probably going to be planning changes. I think there'll very likely to be taxation and licensing, changes. But it will take time. So, I think it's another of those wormholes that you've no idea how long it's going to go on for.
So don't wait for the end.
Don't wait for the end.
Make some hay now.
Make the hay now, absolutely. But just don't put all the eggs in one basket.
Yeah.
So, maybe have a couple of other strategies you're running side by side.
Yeah.
The old days of sort of single let or HMO. There were a lot less regulation there. There was a lot less licensing, all that sort of stuff. It doesn't mean to say you can't do it now. It doesn't mean to say it doesn't work. It does. But it was a good idea to diversify. Yeah. Make the hay. And there's a lot of people saying, I won't do it because they're going to bring all these regulations in. Well, yeah, but there's between now and how many years where they won't necessarily stop you doing it. They may just increase the cost of doing business.
Yeah, and so it could change. I know there was Airbnb just won a case in France that I only saw today where they're not held accountable as an estate agent, which is positive.
Yeah.
Whereas Uber have been held accountable as a taxi firm. So it could pan out differently for holiday lets and Airbnb and Booking.com than it has for places like Uber.
Well, it's bound to on a national level as well, because this is also dependent on which jurisdiction you're operating in, because French law is nothing like our law.
Yeah.
So it's going to be different in different parts of the world, as it is with Uber.
Okay. Are there any strategies that you think are something you would steer away from in 2020? Anything that you think is starting to not work as well as it has, or do you maintain that everything is good in moderation in a diversified kind of portfolio?
I suppose Boris says he's going to reduce business rates on retail and some other sort of commercial. If you're investing in the use classes that he's not targeting, I don't know, maybe you'll see less benefit there.
Yeah.
So that could be quite good. They know they need to reduce rates, I think, on the high street. They say they're going to do that. I think there's a lot of positive there. Things I really wouldn't do at the moment, not really. I mean, prior to the election, I was very much for diversifying into commercial more. Yeah, maybe stay with the residential, but do both. Just because the policy had become very sort of anti-landlord and acrid, and it seemed to be heading in that direction. But I'm a lot more encouraged. Yeah.
A question I'm sure you get asked a lot. We mentioned before about the house price and market cycles we have in this country, and I'm sure people have asked you, like I'm going to ask you, where do you think we are at in that cycle? Do you think we're on a long-term upswing after a period of uncertainty and we've avoided a massive crash, or do you think we're still at some point in the relatively near future going to have that crash before we have an upswing again, or do you think it's just impossible to tell?
We're in the second half of this cycle, and clearly there will be a crash, and I suspect that crash comes sometime in the next 10 years.
So this cycle has just been a longer one than the previous ones we've had?
Not really. I think this cycle started in about 2010. We're now 2019, so we're 9 years in. For me, the previous cycle probably started about 1993, 1992, and ran to 2007. It came off. And hit its drop in 2009. So, but you can't. It's not like a piece of tracing paper where you can just lay one over the other and sort of go, cycles are this long. People like to do that.
Yeah, they like to imagine it's a formula they can figure out.
Because they want to know when the next crash is, but it just doesn't work like that. each cycle has different ingredients in it, and therefore a different cake is baked each time.
But you'd say, in your educated opinion, we're probably still got a little while of upswing left before we have a significant crash.
You can't say that. No.
I'm asking you to say that.
Yeah. I don't agree with that statement. Yeah. I think I think it's impossible to predict exactly when the next crash is going to be. You can just sort of say it's guaranteed to happen, and it's sort of in this rough zone. So, yeah, I think in the next 10 years there will be another one. I can't see one happening in the next. Nothing to say something's happening now or in the next 6-12 months, but by their very nature, it's usually a black swan event.
Boil over quite quickly.
Yeah, something that's not been predicted comes along, because if it was predicted, then usually you'd like to think the policymakers then make changes to avert the crash.
The people involved, their interest is to keep it private as long as possible. And
Absolutely.
Then, as we saw with the 2007 crash, everyone pretended everything was fine until one day when it all just happened.
Yeah. Yeah, I mean, 2008 crash, clearly it was happening in America. Our banks were saying, no problem here, no problem here. The policymakers, the governor of the Bank of England, they all had to deny it because they wanted to avoid contagion.
Yeah. And that's that, need for stability and consistency, which is, I guess, the foundation for, your economy to be solid, isn't it? You can't thrive if there's uncertainty. So everyone has to kind of hold the line on certainty for as long as possible.
Yeah. And the previous crash in the late 80s, early 90s, I was a bit young, I wasn't quite conscious at that point, but everything I've read, says the trigger point was the exchange rate mechanism. And we tried to defend the pound against short selling, to defend our place within the European exchange rate mechanism, and the government ran out of money. Couldn't defend it, and obviously the pound got hit quite hard, and that sort of created a recession. But these events are usually the straw that broke the camel's back. There are usually many years of imbalances, as was the case in the run-up to 2007, that creates these situations. So
we have a more global economy than ever now, all tied together. Things could be happening in the other side of the world that will affect our housing market through, investments and funds and all those kinds of
things.
things.
China, trade, that's always the big thing. Trump's putting tariffs and barriers on Chinese imports into America, therefore that creates a maybe shallow global recession. That's a narrative that's been tabled, quite a a few times over the last sort of 2-3 years. The Germans going into recession. The international, or should I say, the car manufacturers all around the world are suffering. They're going through a really, really bad patch. Clearly, that hits the Germans quite hard because it's a big part of their economy. The electrification of the of automobiles is very costly, and they're not making profit out of electric cars. In fact, they make a loss when they sell each one, so they're not particularly popular with a lot of the manufacturers. And there's all these sort of diesel crisis and issues that are coming through with that. So I think that's sort of affecting maybe the Germans, and the Americans and the Chinese have got all their sort of trade issues, but I don't know, it hasn't pushed us into recession yet. Maybe Germany, a light recession, but not us and not the US.
And where would you, obviously you're very informed, you keep abreast of all these things. Where would you say for people to go to keep up to date with this stuff? Because I think a lot of people don't know the best places to keep up to date. Where do you read?
I think the Financial Times, The Economist, I think they'd be sort of the best two. The Bank of England inflation report, which comes out once a quarter, that's the horse's mouth. You can listen to that. Everything that you see in the Daily Mail about interest rates and that ends up in the Times.
That's an echo of.
It is, and it's got that journalist slant on it, and obviously, often the journalist doesn't necessarily understand the nuances. And
well, they're looking for a story. I've got friends that are journalists, and the game is clicks. It's whatever will get the most impact, regardless of truth, really.
Yeah, I think you've hit the nail on the head. So clearly, if you go on the Bank of England website, you can watch a video of the Governor of the Bank of England telling you what's happening to the economy. And those guys, they have all these data sources feeding into them. A lot of them are empirical, but lots of them are just respondents within the economy, businesses, consumers. They tell you what's happening. So I think that is a very, very valuable source of information.
Do you think Mark Carney's going to stay on?
No, he's going. They've got a couple waiting in the wings.
Begging him to stay on for as long as possible.
He's been good.
He's been good, yeah. But you think he'll go this year now that Brexit's going to, because they've tried to keep him through this uncertainty, haven't they? Do you think he'll go now that it's pretty on the cards what's going to happen with Brexit?
I haven't seen the latest sort of talk around the date of his departure, but it looks like he's on his way out, doesn't it? Yeah.
Okay, cool. And lastly, if you could give one piece of advice for investors going into 2020, let's talk about, the traditional buy-to-let investor. Yeah. What would you say to them going into 2020 with everything that's going on, all the, confusion and instability of the last few years? Going into 2020, what would you say?
Everything starts with yield. So make sure what you're buying yields well, and that means probably 6.5% plus. Make sure everything you're buying you can add value to. So you're insulating yourself, you're adding equity, and maybe you can strip some of the equity back to insulate yourself further. Only invest for 15, 20, 25, 30 year period. Lots of people will look at these hotspots, look at, Boris investing in the north, go, I'll get in there now. But, these are often short-term decisions. What you should be doing is looking at where you think will grow, rents will grow, and you'll have a good investment over the next 15, 20, 25 years, because you want to absorb purchase costs, and use the time that you've used to purchase the property and to get the asset, get the benefit of that over multiple years, and to the future.
Okay, great, thank you. All right, and for our last show of the year, just tell everyone where they can find and follow you.
progressiveproperty.co.uk, Mark My Words, which is my podcast, and I'm on Facebook, Twitter, and Instagram.
As always, thank you for watching the Property News Show. We love reading your comments, so please leave them below. Give us your thoughts on what you think is going to happen with the market in 2020. Please remember to like and subscribe so you don't miss a single episode of this. And from all of us at Progressive, have a great Christmas and a Happy New Year.